In today's video, we are going to be uncovering the secrets of the sideways ranges. This will be split into two parts. Part one is going to be about understanding the market direction, high probability trading locations, and then part two is going to be all about entering those high probability trading locations, utilizing the entry strategy. I'm going to be showing you the concepts that has enabled me to catch a 4 winning streak on Euro USD. And not only me, but our traders inside the community trading the 1 minute chart and the 15-minute chart were also able to catch these sell continuations with the knowledge that we're about to share in today's video. Most traders go through their entire career with the intention to stay away from range in markets. They are told things like noise, mess, or unpredictable. But we've spent the last 5 years studying sideways markets, and they are some of the most predictable and high probability markets to trade in. Because the market ranges 70% of the time, they are often the markets that provide the most high probability opportunities to trade in when you understand their repeatable nature. There are a few key setups to look for inside the ranges. We use the RIMC order flow pattern. That is sideways ranges that have initiated either higher or initiated lower and broke out of the range. When price pulls back into these ranges here in the future, this is called the mitigation phase of the orders left inside the range. That's where we see reactions. And then if we continue that intention again, we will see the continuation phase to the upside. Now we can see that the market is in phases. We can see that we go from a sideways range to an initiation to the downside. We go from a sideways range to an initiation to the upside. These are areas when we drag across this range that we can trade in the opposite direction. For example, this sell range that we have here up to the top, if we just draw our area of the sell range here in the future, remember this is a 4-hour chart, you could also do this on a daily or a weekly, and if we draw our also buy area, which is this whole range here, and we think about every time prices come back into this range, we have an opportunity to take sells. Why are we taking sells? Because this is a sell range. How do we know it's a sell range? Price broke out to the downside. Same here, this is a buy range. How do we know it's a buy range? Because price broke out to the upside. So anytime price comes into here, we can look for our buying opportunities. Now, of course, this is a higher time frame perspective. We don't trade on the higher time frame. We add our framework on the higher time frame, and then we can trade these moves here back to the upside or back to the downside based on whether we're reacting from a buy range or reacting from a sell range. Now, a lot of you might look at this and think these are small reactions to the upside and to the downside. Because we use the higher time frame to look for our structure, these moves that we're seeing are 160 pips. You know, this one here, just over 100 pips. Even the move back to the upside, 150 pips. Even some of these small moves that we have in here are 50 pips. We're only looking, if you're trading in Chuck's 1 minute strategy, for 20 to 30 pips for a take profit. Sometimes even less, 15 to 20 pips. If you're using my New York strategy, you're looking for a 40 pip take profit. So this is why we utilize the higher time frame reactions first, because all we're going to do is look for continuations away on the lower time frame when we get into these locations. That means that we're going to get an abundance of opportunities from just identifying one sideways range on the left hand side of the charts, which is then going to give us our directional trading on the lower time frame when we see continuations away. Price is always between two ranges. So if we look at current price right now, we can see that price is reacting from this buy range here. Why is it a buy range? Because we broke out to the upside. And this reaction that we see here, if we look to the left hand side of the charts, we're here on the daily, we look over to the left, and all we do is just identify the range that price is reacting from. Price is contained between a low and a high before we broke out there to the downside, and then we just draw that across, right? All we're doing is waiting for price to react from this area here in the future. We don't have to predict that price is going to react from this range. We just identify the range. Over on the right hand side is where price has reacted from this range, and then we draw it on. So let's go back to the 4-hour chart. So this is current price. So how would we play current price? Well, based on the fact that price has reacted from a buy range, when we get into this range here in the future, we look for bullish continuation away on our 15-minute time frame or our 1 minute time frame. Now, based on the fact that price has moved into this sell range, we do exactly the same thing on the opposite side. We look for bearish continuations to get involved in away from this point of mitigation. So this is the pattern that helps us to understand the direction within the market. And that's based on current price. So you can see what our intentions are right now with current price. But let's go back to our range. Now we have our understanding of direction. What's the next framework that we can use to understand high probability locations? Because We don't just want to be understanding direction here and then be taking our trades up here, because these are way too high within price. We don't want to be buying high, we want to be buying low, and we want to be selling high. So one of the frameworks that we use inside NJT is called the location tool. And what we do is when we understand prices contained inside a sideways market or a messy market, what we do is we find the highest point and the lowest point of the range, and we draw on our ranging structure. Now, what this is going to do for us is give us our locations to look for the buys and give us our locations to look for the sells. So we only want to be buying at the lowest 25%. We only want to be selling at the highest 25% in the direction of the reaction that we're seeing from the previous sideways range. So here is the ranges. We're between a buy range and a sell range. Now, when price gets down into the bottom 25%, this is where we can look for our buys to the upside, because we'll be buying low inside the range. And when price gets into this top 25% in this sideways market, we can play our sell range, range initiation, mitigation. Anytime price comes back into this sell range in the top 25%, we'll be looking for our sells away. So this is how we apply our framework onto a sideways ranging market so that we can make sense of the mess, and we can look to buy in locations that are the highest probability and sell in the locations that are highest probability. If you're wondering what we do inside here, we stay away from these markets. This is sit out times inside the sideways range. If we want to think about highest probability and lowest probability, we only want to be looking to take our trades where we have clear direction and clear intention here from these points of mitigation at the edge. And when we have less clear intention in the middle of the range, where there's a lot of liquidity being created and taken, this is where we don't want to be looking to get involved in the market. These are the low probability locations. So our framework already shows us the best locations to look for our trades. Now we've understood how we trade direction with the RIMC order flow pattern. We've understood when price is in a sideways range, the locations that we're looking to take our trades from and the locations that we're looking to stay out of. So we have the high probability locations and we have low probability locations. That is then our framework to then start to look to take trades in the market. So what I'm going to do now is just go through some trades that I took utilizing these same concepts. So here is 3 selling opportunities that I took inside this sideways range. This was off the back of a 4 winning streak on Euro USD using my 15-minute strategy. So let's go down to the 15-minute now and analyze these trades. So we're now down here on the 15-minute chart. We can very clearly see prices reacting from this sell range from our higher time frame. So anytime prices come back into here during our session is when we can look for our sells. The way I enter the market is always based on the same repeatable processes. So what I'm going to do is I'm just going to bar replay how price delivered into this area so you can start to understand what my processes are for execution. So first of all, we can see that price is in bullish continuation structure here to the upside. Now for me to look to take a sell, I need to see price starting to slow down. And the way that I'm going to see price slowing down is I'm going to be looking at these previous highs here within the market and seeing how price is delivering through these highs. My session starts at 1 p.m. so it's 6:30 a.m. so I have plenty of price action before my session begins just to analyze and see what the market is doing. Here we can very clearly see price has extended through this high. Now when price extends through the high, to us it shows that price wants to continue trending. So we're going to be looking for those pullbacks and continuations. So if I'm looking to sell from my sell range, this price action in current price is telling me that price doesn't want to stop and move in the opposite direction yet. So the only thing to do is to be patient and wait to see how price takes out highs. So here we see price starts to pull back. We run above the next high here. Now we can think about how do we break above this high. We can very clearly see when price run this high, we had a strong rejection of higher prices. Now this is the sort of price delivery here that is telling us that price is slowing down. Now when price does slow down, that's the opportunity for a new intention to be created back to the downside. Now if we just zoom out again, where are we located? We are back inside our previous sideways range that we had here on the higher time frame. So we already know our direction. So all we're doing is waiting to see price slow down inside this area. Then we wait to see our session begin and we look to trade the overall direction for the session. So let's just play this forward here. And we can see that price is just overall ranging, which is actually a very good sign when price is contained between a high and low point, because when we break out of the range either to the upside or to the downside, the next phase of price is always the initiation, which is an aggressive market to the upside or an aggressive market to the downside. We see here, sideways market, initiation. Again, sideways market, initiation. Price is repeating this RIMC order flow pattern consistently. So when price is creating sideways ranges and we're getting involved inside the range, we can play the next big phase of price, which is always the initiation out of the sideways range. So then it's just about where am I positioning myself inside the range. I wait for my session to open, which is at 1 o'clock, and I just press sell at 1 o'clock. So I was in this trade here for the short. And the most important thing is seeing price slowing down when we're in bullish momentum, because then that's price telling us that it wants to move in the opposite direction. So this is confluence building. Let's break down the confluences. We're at a higher time frame sell RIMC order flow pattern. So we know that we're only selling inside a sell range. We're inside a sideways ranging market and we're coming into our top 25%, which is our high probability sell location. On my entry time frame, price was in a bullish trend, but we saw price slow down, which shows that price wants to move in the opposite direction. These are adding to our confluences. And now I'm selling during the session, and what happens during trading session is the volume increases. A move is about to come into the market. Every New York session and London session, there is a move that happens that follows a direction. So with these confluences on my side, it's telling me that price wants to move to the downside, which is why I'm looking to sell within my session. If I sell from high probability sell locations and I have a positive risk to reward, that is what makes me a consistently profitable trader. So this one, I always manage it in the same way. I go to break even at the same time, and then I just let the trade play out overnight, whether it's going to play out or not. Right? The most important thing with this trade is that it's following the same repeatable process and the same entry criteria for the trade to either play out or not play out. So this is one of those trades that ended up seeing a continuation to the downside into the next day and banked me a 1 to 4 risk to reward. So you can see that the trade is always following the same repeatable process. I'm entering in a high probability location. I'm selling from a higher time frame sell range, and then I'm just executing at the market open and allowing the risk to rewards to make me consistently profitable. Thank you very much for watching. I hope you enjoyed the video. Make sure you leave a like and comment on the video if you did enjoy it. Check out more of our content in the description of this video. You can download a free RIMC PDF or check out some more of our content here on YouTube. If you want to join the community and gain our exclusive content, which includes our strategies, our entries, the exact rules behind them, and you want to be mentored by me and Chucks, make sure you go down into the description and you enroll into the community. Thank you guys for watching, and we'll catch you on the next video.